Good evening, ladies and gentlemen. Thank you for taking the time to join Puravankara Limited earnings call for the third quarter of FY23. I am Neil Gautam, President Finance at Puravankara Limited. Thank you for joining us today. We are pleased to present our financial results for the quarter ending December 31st, 2023. The results, along with a comprehensive presentation, have already been made available for your review on the stock exchanges. To begin with, let me share my thoughts on the broader circumstances, both globally as well as on the macroeconomic front. Amidst global uncertainties, India's economy remained robust, evidenced by the RBI's upgraded FY24 GDP growth forecast to 7.0% from 6.5%. A stable interest rate and controlled inflation bolstered economic prospects. The surge in demand for residential real estate mirrors increased economic activity and rising income. In 2023, the strong interest from both foreign institutional investors and domestic institutional investors boosted India's global index rate. Political stability and ongoing economic reforms position India as the fastest growing major economy. Turning to the performance of our company, Puravankara Limited, the first 9 months of FY24 have witnessed exceptional pre-sales, marking a strong growth of 89% compared to the same period last year. We achieved a sales value of 3,967 crore for 9-month period FY24, the highest ever for 9-month period since inception. In the Q3, coming to the quarter sales number, the sales performance across our brands showcased robust figures. Puravankara led with INR 663 crore, Provident followed closely at INR 419 crore, and Puravankara contributed INR 158 crore, with a total sales value of 1,241 crore, which is 60% up compared to the same period previous financial year. Now, coming to the geographical contribution, Bangalore emerged as a primary driver, capturing a dominant share of the distribution, followed by Chennai at 27% and Cochin by 9%. The average realization was INR 7,620 per square feet for the quarter. However, if you look at the 9-month period, our average realization was 7,916 rupees per square feet. Coming to the new launches, Bangalore, we introduced a Provident Gate, boasting a sellable area of 0.6 million square feet with an initial launch area of 0.3 million square feet. Meanwhile, in Chennai, we presented Purva Southam, a plotted project with a sellable area of 3.16 million square feet, initiating with a launch area of 0.8 million square feet. Coming to the business development front, we expanding our horizon in aligning our strategic vision. We eagerly step into the Mumbai redevelopment market. Our inaugural project encompasses approximately 6 lakh square feet with a gross domestic value of about 1,500 crore. The Mumbai landscape holds tremendous potential, and we are actively pursuing several opportunities, currently engaged in advanced discussion with 4 societies. Our launch pipeline is equally robust. We have an impressive launch pipeline of approximately 13 million square feet, ensuring a steady flow of new projects in the coming period. Non-Bangalore projects now account for 42% of the share of ongoing and 77% of launch pipeline. On a division basis, Provident accounts for 44% of launch pipeline in the line with market trend and the group's strategy. Coming to the debt management, in addressing our debt, we are pleased to highlight a positive trajectory. Demonstrating a fiscal prudence, our net debt has reduced from INR 2,135 crore in Q3 FY23 to INR 1,741 crore in Q3 FY24, making a substantial decrease in net debt to equity ratio from 1.09 to 0.85. Notably, our debt has decreased by INR 251 crore and gross debt by INR 53 crore from the previous quarter. Equally significant is the decline in the debt per square feet of building space, dropping from INR 1,291 crore in Q3 FY23 to INR 791 rupees in Q3 FY24, reflecting our commitment to efficient capital utilization and fiscal responsibility. With this, our debt per square feet of under construction area has decreased by around 62% over the last 5 years. Coming to the customer collection, has been a driving force in our financial performance, totaling to INR 2,516 crore for the first 9 months of FY24 and 941 crore for Q3 FY24. These robust collection figures underscores our commitment to execution excellence. The impact of our effective collection strategy is evident in the operating surplus, reaching INR 418 crore for Q3 FY24 and INR 965 crore for the cumulative 9 months of FY24. Remarkably, our operating surplus has experienced a substantial year-on-year growth of 101%, a testament to our aggressive execution, heightened collection efforts, and operational efficiency. I would like to draw your attention to the fact that as on December 31st, 2023, the balance receivable from our sold units is amounted to approximately 3,857 crore. This impressive figure covers around 78% of our remaining costs required to complete the inventory currently open for sale. This indicates that a significant portion of costs to complete the remaining inventory has already been secured through receivables, providing us with a strong foundation to meet our financial commitments. Moreover, our cash flow visibility is equally promising, with a projected amount of INR 6,747 crore expected over the period of 3 to 4 years. In addition to this, there are cash flows from 2 new commercial projects. If we value this today, it is about 1,308 crore. This signifies our sound financial planning and ample cash reserves to support our operations, projects, growth initiatives, and in the foreseeable future. Finally, turning to our financial performance, in Q3 FY24, our total revenue grew by 45% year-on-year to INR 596 crore. The EBITDA for the Q3 FY24 was 218 crore with a 37% EBITDA margin. The PAT for the Q3 FY24 was INR 78 crore. For 9 months FY24, our total revenue increased by 37% to 1,313 crore in 9 months FY24, which was 961 crore in 9 months of FY23. The EBITDA for 9 months FY24 was 392 crore with a 30% EBITDA margin. The PAT for the period of the 9-month period was 49 crore. In conclusion, I want to highlight that Puravankara is well set to benefit the real estate sector's growth nationwide. Our strong sales, consistently beating targets, are thanks to careful project choices, effective marketing, connecting with customers, and the commitment to delivering great products. As we move forward, thank you for listening. And now I am closing my opening remarks for your questions and suggestions. Me and my colleagues are here to answer all your questions and take the feedback which you would like to give us.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handset while asking question. Ladies and gentlemen, we will wait for a moment while question queue assembles. The first question is from the line of Chintan from Purneshika Family Office. Please go ahead.
How many units we have delivered this quarter?
498 units have been delivered.
Okay. And what are the plans for FY25? How many square feet we have delivered to planning?
So, while we don't give any guidance numbers, we will come back with the exact number that we are looking at delivering in the next financial year.
Okay. And sorry, in last phone call you mentioned that we have pending delivery of 2,500 units in H2 FY24. So now we are pending of close to deliver of 2,000 units, correct, sir?
Correct, you're right.
Okay.
We have already delivered about 1,405 units for 9-month period.
So now we have OC already we have received for 3 of our projects in the last quarter. Towards the end of the last quarter, we are expecting 3 more projects to give OC within next 2 fortnights. There are final stages where we are expecting the OCs to come in, and those deliveries will happen. So I think the last quarter we've been mentioning for a long period of time will be possibly one of our biggest quarters for delivery, because all the OCs and the delivery of the projects are coming at that time. And of course, the handover, it takes a little time, but once the OC is there, then it's only a matter of time for delivery.
Okay, understood, sir. And sir, what is the current unrecognized revenue?
So sold revenue as of now, as of today, just open the slide of the sold value is cash flow.
If you go to our balance sheet.
Correct.
If you go to our
Go ahead.
Now, I was thinking, if you go to the cash flow plus revenue to be recognized, cash flows, if you go to our slide number 29, that gives the detail of the balance receivable from the sold units. However, the question, I understand your question is more related to how much balance revenue to be recognized. If you go to our, we have not published the, in this 9-month period, the balance because that is not required to be published. About 6,000 crore is a sales value, which is advance from customer for which I have yet to recognize the revenue, which is part of our advance from customers in the balance sheet. Unsold, of course, unsold which can sell, which are the value of our sold, unsold inventory, which is there in the slide number 29, is about 5,617 crore, and of course, as I mentioned to you, about 6,000 crore is the advance received from customer where I have yet to recognize revenue. However, I will send you the exact numbers of the line.
Okay. And sir, if I look at your cost of borrowing, it's close to 11.92. Any efforts we are doing to bring it down more? I mean, whether real estate players are taking borrowing or any efforts or any plan for it?
Yes, it's very much a plan. If you look at my cost of borrowing has come down compared to the immediate previous quarter. It's 11.49%, which was the previous quarter is 11.61%. So as and when I'm launching project, I'm converting to this into the bank loan and reduced interest rate, and which is already reflecting previous quarter to this quarter, which come down, and we are putting the continuous effort to reduce interest rate by taking new loans at a competitive rate and refinancing the existing rate also for a lower interest rate loans.
Okay. And sir, for the commercial project, we are looking to lease it out or to sold it out? I mean, how we are?
So currently our goal is to lease out one asset and sell one. There is one asset which is about 2.1 million square foot, which is under construction on the airport road in Bangalore. And the other one, which is at Kanakpura, which is about 800,000 square foot. At this point in time, we haven't sold anything. Very active interest is there in leasing. There are multiple LOIs which are currently in progress. So, we'll wait it out and see how it goes. If we can hold on to the inventory, we prefer that, the whole lease model, because we want to build a portfolio over the long term. However, one is a JDA, one is an own asset. 2.1 million, which is an own asset, definitely we are going to own and keep. The JDA asset, we will evaluate as and when we get closer to completion. Currently, we are out for leasing for both assets.
Okay. One request from head, can presentation the position date of the each ongoing or under development project, that would be a great help for.
Yeah, sure. We'll make sure that we can publish the expected date of completion of these projects.
Yeah. Thank you so much, sir. Congratulations.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Mr. Ashutosh Mittal from Axis Capital. Please go ahead.
Yeah. So my question is related to your entry into Mumbai redevelopment. So you guided for you had an advanced discussion for 4 projects. So what kind of projects and what micro market specifically you are looking at? And how would the margins be different for these projects versus your other existing projects? Thanks.
So we are looking at all the markets both in the western and central suburbs and of course in South Bombay. Currently actively pursuing, actually we have participated in more than 12 projects in terms of the tendering process, active shortlisted conversation engagement going on 4, mix of all 3 markets, which is south, west and central. And from the margin point of view, we are continuing to target our EBITDA margin of about 30%.
Okay, thanks.
Thank you. The next question is from the line of Vignesh Iyer from Sequence Investment. Please go ahead.
Sir, thank you for the opportunity. I just wanted to know which projects are expected to get OC in the coming quarter, and could you tell me how many units is coming from this each project?
So we are expecting Xenium, Somerset, Promenade, and Tivoli. Tivoli partially we have received the release of sites. The balance we will get now in this in the coming week or 10 days. Between all of these, the total inventory would be about 1,400 units. We also got OC for Equinox in the last quarter. So in all, if you take including the last quarter, we'll have about 2,000 plus inventory available with OC.
Okay. Including the quarter 3 OC, right?
Yeah, will be available for handing over. About 2,000 plus units will be available for handing over with OC.
Okay. And when it comes to, so we have got a good pipeline in quarter 1 of FY25 and followed by quarter 4 and quarter 1. So what is the pre-sales target that the company, what is the internal estimate of the pre-sales target for FY25 for the company, unit-wise and maybe even value-wise, if you could help us understand?
So we don't give guidance, as I mentioned earlier, on what we are expecting in terms of the sales numbers. But we do publish our expected launch pipeline. And from our past track record, you can kind of assess for yourself, but we normally don't give guidance on the... But what we do give guidance on is the number of launches that we are looking at doing.
Okay.
If you look at our slide number 20, slide number 16, that will kind of give you a trend of the sales trajectory that we have achieved. For example, for the 9-month period last year versus this year, we were in 23 at 2.78 million square foot for 3 quarters. This year we are at 5 million square foot for the 3 quarters. I think the sale value has gone up by about 89%, and volume has gone up by a little over 90%, if I'm not wrong in the number.
Okay. So going by the trend, we can expect similar or better performance going ahead. Would be the right like you have done a CAGR of 28% in last 4 years. So we can expect a similar line improvement going ahead, right?
Look, again, as I said, we don't give guidance, but our effort is definitely to continue our growth trajectory.
Okay. Right. Yeah, that's all from my side. I will get back in.
Thank you.
Thank you. The next question is from the line of Shivan Joshi from Centrum PMS. Please go ahead.
Hello.
Yes.
Thank you for the opportunity, sir. I hope I'm audible. So you indicated on one of the slides about your launch pipeline for the 4th quarter. Just wanted to understand there are 6 projects in that slide. I'm referring to slide 22. What is the state of approvals for all these projects? I mean, what is the likelihood of any project launch getting delayed to 5 a quarter or 2?
So no, there are none of them which will get delayed by a quarter or 2. We are actually at the final stages of all of these projects. Some of these are already approved projects where we are opening a new phase. We already have the approvals. And some of these projects we will get the approval. So, we are confident that we should be able to take these to the market in between this quarter and the next quarter. There is nothing that out of this inventory that will go to the quarter beyond this quarter and the next quarter.
Okay. And indicatively, can you give a number as to, I understand you gave your launch pipeline for next year, but a ballpark number as to what will be your area to be open for sale, new projects as well as new phases in existing projects for FY25? Any number?
So look, if you look at our current inventory, which is available for sale, it's about 5 million square foot. What we have sold already in the 9-month period is 5 million sq ft. What we are planning to add and open for sale from the launch point of view is about 8.86 million, almost say 9 million sq ft we are going to add in next, say, 2 quarters. Now, if you look at this trajectory and our existing, what is inventory available, which is not open for sale, I think we will continue to open approved project for sale as we get, we have our own internal criteria that only upon certain percentage of sales having been done, we will open for sale. But our goal obviously will be to continue our growth momentum. Last quarter, we will see where we land up. It will obviously be 5 plus X million sq ft. And then again, the next quarter. So, our endeavor will be to continue the growth momentum. And we will publish our data on next year's launches in the first quarter of the next financial year.
Okay. Yes. I just wanted to understand, since you will be, or you are venturing big time in Mumbai, what kind of outlook will you have? So when you mention margins, you have been giving a brief idea on what kind of project level margins that you make, including your target 30% in Mumbai projects. What would be the overheads over and above this project overheads? If you can just briefly indicate, I mean, since you are aiming big in Mumbai markets now.
Sorry, so are you asking, just to confirm, you're asking about the margins only, or is there any other question you had?
Margins only, but 30% I believe would be at project level. What kind of other overheads do you have in your books?
Look, so, if you look at our standard model, EBITDA number will continue to be 30%. And when we say EBITDA, it's largely, the cost of capital that is left for the calculation of the PBT. So we will continue to target, the cost structure there. How we operate is a percentage of the construction cost, and we target that percentage of construction cost. In fact, fortunately, because we are kind of a player who is multi-regional, we have scale, and that helps us keep our overheads in check and under control. And we have 3 different brands which require different level of overheads, versus a Purva land where your turnaround time is very short, versus a Provident where scale is very large, versus a Puravankara where it's all premium and the construction cost is slightly higher. So, on an overall average, we are quite certain that we should be in the 30% ballpark range or plus. As far as each of the brand is concerned, I think we are, and region-wise is concerned, our average goal has to be at 30%. Provident may be between 27 and 32%, Puravankara between 30 and 35, and Purva land will be in excess of 35% EBITDA numbers.
Okay, last one from my side on the debt piece. So your debt numbers have been coming down well. From a strategy perspective, wanted to understand your foray into Mumbai, or rather the western region, Mumbai and Pune, should be more asset-light? Can you correct in my understanding? And if that is the case, then any rationale behind keeping 800 crores cash and not prepaying something which is costing 11.5%?
So I'll answer this question in 2 parts. One is, as far as the model in the western region is concerned, it is a mix of redevelopment, joint development, and outright. We always believe that there is a lot of margin to be made in an outright transaction as well. Of course, Mumbai as a market, it's hard to find enough outright transactions, so largely will be redevelopment and maybe JDA to some extent. Pune may be a lot more of outright because there are opportunities available there. Having said that, coming to your cash balance question, I think what we are doing now is going in an aggressive investment path, because if we have to continue our growth momentum, as we have said on the debt piece, we have said that we will keep it range bound. Somewhere between 2,000 2,200 crores, in that range is what the net debt is, what we are intending to keep it as. And on a per square foot basis, more importantly, because it's obviously a question of scale versus, the debt you've got. On a per square foot basis, our target is to keep it, if our average realization is between 8,000 to 9,000 rupees, our target is that we should keep our range, our debt per square foot of 1,000 rupees per square foot or lesser. So keeping those numbers in mind, because if you want to do larger volumes and keep your debt, there is a natural course in which the debt is going to get repaid. So one is use of capital is going to be, of course, is always an opportunity to return capital. We are in active conversation in some places to return some of the capital ahead of time. And at the same time, deployment of capital towards new investments which will add GDP and bottom line for us. And of course, there is some bit of liquidity that is always kept in the system for our organization and size of our scale.
Fair. That answers most of my questions. Just last thing, since you mentioned 2,000 to 2,200 crores sustainable debt number, say 2 years from now when your commercial development is at advanced stage or complete, what would be the total debt? I believe when you're saying 2,000 to 2,200 crores, that includes your commercial debt.
See, as I said, I mean, there are two contexts. Commercial is to be treated very differently. I'll explain myself a little bit. In commercial, you're creating an asset. The moment you have leased out the asset on a LRD basis, the asset gets completely 100% freed out, even if you do an LRD, depending on how much loan you have taken, anywhere between 4 to 6 years time frame. So our goal is to, and so that debt is pretty much self-liquidating. The second category of debt is residential, which is also self-liquidating, is because if you see our debt pool right now, and we publish now that data on how the debt is moving in each of the categories, you realize that in its natural course, a lot of debt is going to get repaid because these projects are self-repaying as we launch these projects, right? So in our mind, all of the debt is pretty much self-repaying. The capital invested in commercial assets and the debt thereof, which is getting repaid through LRD, obviously the cost of capital is much lower, and then your asset gets free over a period of time. And on the other side, residential gets. So having said that, I'll go back to my earlier conversation and I'll say that our debt is going to remain range bound. That's the target which we are working towards, both on a per square foot basis, and goal is obviously to try and see how we can make sure that the volume goes up significantly so it becomes irrelevant really to have this conversation on debt.
Okay, that's fair. Thank you. Thank you so much for answering my questions, sir. And congratulations once again on a good set of numbers. Very good.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. The next question is from the line of Ronald Sioni from Puravankara Limited. Please go ahead.
Yeah. So, sir, congratulations on good set of numbers. And, during this quarter, we have seen good margins, around 35% operating margins. So, it was just because of job or sales mix, because of Purva land getting more booked during the quarter, or are there any one-off items in these margins?
No, so see, revenue recognition is a factor of the handing over possession and any real estate related transaction that we may have done. As far as pre-sales happen, pre-sales have no impact on the revenue recognition. So therefore, these numbers are clearly from the real estate activities that we have done.
Yes, yes. So that's what I meant to say. So more revenue booking was towards the Purva land projects, or?
No, I will share that breakup offline. I think we've handed over a lot more in Puravankara and in Providence, but we'll share that offline with you.
Okay. And this kind of margins are sustainable going ahead also, or their margins can vary to a larger extent going ahead for sales?
So, let me explain this in this context. Our margins are pretty much on target. It's more a matter of time on when you recognize the revenue and how the margin looks in a particular quarter. So if you look at it over a period of time, it will always average out with the kind of margins that we are working on, because as you deliver these projects, your pre-sales convert into your revenues, and therefore your margins start showing up on the books.
In addition to that, I would like to add is, as we are scaling up in all our fronts, in terms of sales, in terms of construction, so fixed cost, which is there in the company, will of course, it will come down per square feet and as the scale goes up. So to that extent, margin will improve.
Okay. And second question was, where you like you are closely looking at to close a deal in Pune. So, what kind of at what kind of level you are there in Pune, to go ahead with some outright or JD acquisitions in Pune? When should we see, Pune acquisitions to start?
Well, you will see acquisitions happening between this quarter, next quarter, and thereafter. So we will start hearing some announcements happening in coming quarters, including this quarter.
I just want to add that we have received OC in one of our important projects in Pune. Just thought to update you. Of course, acquisition plan, Mr. Sheikh has mentioned about it. We have a project Purva Silversen, where we have received OC during the quarter and started giving mandate positions.
Okay, great, sir. And my last question was on this various Provident and Puravankara and Puravaland. So both in terms of the mix of the different segments and different geographies, where you are seeing a better traction and where the segments which are lagging, both segment wise and geography wise.
Look, of course, our biggest volumes have come from Bangalore. But having said that, currently our projects are active in all the markets, which is Bangalore, Hyderabad, Chennai, Kochi, Mumbai, and Pune and Goa. Across all of these markets, we are seeing traction, and one can safely say that we are not seeing any challenge. In fact, we are seeing increased momentum in our sustenance projects at increased prices because the projects are getting more and more visible towards completion. So we are confident that that sales momentum from all of these regions are cutting across Puravaland, Provident and Puravankara will continue to be there.
Okay. Thank you very much, sir, and best of luck.
Thank you so much.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. The next question is from the line of Deepak Purswami from Seven Investment. Please go ahead.
Yeah, good evening, sir. So just wanted to understand our strategy on the Western India. We mentioned we are looking out for the 4 projects in the Mumbai region, and then there are some projects we are looking in the Pune market. So could you please throw some light in terms of the investment outlay we are highlighting over the next 12 months for these geographies? And also, if these things materialize, what would be the GDV addition we would be looking at out?
As far as an already acquired project is concerned, we have added a GDV of about 1,500 crores with our first redevelopment project, which we have acquired at Lokhandwala in the western suburbs of Mumbai. We are, as I mentioned earlier, in active engagement with multiple societies for redevelopment, and of course multiple transactions which we are engaging in Pune market. Having said that, I think your question was on the capital outlay. We are expecting over next 9 to 18 months time frame to deploy approximately 1,000 crores in the western region, including all of these markets.
Okay. So, sir, if I were to...
This is in addition to what we have already deployed and the projects which are ongoing.
Okay. So from the cash outflow point of view, if I were to think, on an average, we would be requiring 1,500 crore kind of cash outflow for the construction, and 1,000 odd crore would be this investment in the new project, and apart from this, there would be a kind of debt repayment to the extent of 750 odd crore over the next 12 months. Would that be the correct understanding?
Not really, because we are also going to be making investments in southern part of India in all 3 brands, which is Puravankara, Provident and Puravaland. So obviously that also needs to be factored in when we are looking at the free cash flows from the business, because a lot of free cash flows will get deployed instead of on repaying debt towards these new acquisitions and then taking them towards launch.
Okay, got it. Thank you. Thanks a lot, sir.
So I must add, that a bunch of cash is also going to go into, so we still have land bank which we are working on, which is from within the company, which also will get unlocked in the next year. So there's obviously capital going in there as well. I missed out on mentioning it.
Okay. Thank you.
Thank you.
Thank you. A reminder to all participants, you may press star and one to ask question. As that was the last question, I would now like to hand the conference over to management for closing comments.
Thank you for joining us for today's call. I'm wishing all of you happy Republic Day, and me and my colleagues are available. If any further question you have, you can write to us. We'll respond to your questions. Thank you.
On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line.